Spring is historically the most active real estate season of the year, but right now, transaction volume is effectively frozen. Both buyers and sellers are trapped in a deliberate holding pattern, unwilling to make a move. They are watching a constant stream of macroeconomic news, specifically persistent inflation concerns and global military conflicts, and it is freezing them in place. The logic keeping them on the sidelines is simple. If they just hold out a little longer, these economic pressures will force mortgage rates to plummet. But that widespread pause relies on a misunderstanding of how macroeconomic data actually influences local housing affordability. Look at how consumers react to the monthly national jobs report. When payrolls fell by 92,000 in February, the immediate public interpretation was that the economy was cooling down. Buyers attach a flawed assumption to that data. They believe a cooling labor market guarantees an immediate decrease in borrowing costs. Monthly labor market figures frequently contain short-term noise and revisions that can distort the broader economic picture. Borrowing costs only take a massive dive if the labor market deteriorates sharply enough to signal a severe, broad economic downturn. This creates a conflict of interest. The severe economic deterioration required to slash mortgage rates is the same force that puts your own household income and job security at risk. Global energy markets and geopolitical tension currently dictate the path of mortgage rates. Widespread military action in the Middle East introduces immediate fear into the market regarding sustained disruptions to the oil supply. When fear keeps oil prices high, it keeps broader inflation firm. And as long as inflation holds firm, borrowing costs for mortgages cannot drop. This creates a condition known as central bank hesitation. Central bank hesitation is when financial institutions refuse to lower interest rates because the threat of inflation remains high. We can see clear evidence of this hesitation by looking at the Bank of England. Citing military conflict and inflation risks, the institution officially delayed a planned interest rate cut, removing a March reduction from the table entirely. Global instability has canceled the possibility of rapid spring rate cuts, enforcing a higher, sustained floor under mortgage rates. To understand why daily news doesn't equal long-term trends, we have to look at the actual financial mechanism that dictates mortgage rates, the 10-year Treasury yield. The 10-year Treasury yield is a government bond rate that reflects the broader market's long-term expectation of inflation and monetary policy. This chart compares short-term energy panics to long-term bond realities. Chaotic spikes from oil shocks overlay the smoothing 10-year Treasury yield. Unless disruptions last months, the initial shock fades. Because mortgages track this slow yield, reacting to daily headlines only causes emotional whiplash. Obsessing over the daily macroeconomic news cycle is a massive distraction from the financial forces that actually matter to your purchase. Since timing the global macroeconomy is impossible, you must shift your focus inward to your own microeconomic reality. The primary questions you need to answer are entirely personal. Is your job secure? And will your family have to cut back on expenses in the near future? The realistic path to affordability will not come from plummeting interest rates. It will happen gradually through your own personal income growth and slower home price appreciation. You need to define a strict budget comfort zone based entirely on today's higher rates, assuming they will not drop a single percentage point. Surviving the spring market requires ignoring the unpredictable global economic weather and focusing entirely on building your personal financial armor. We are currently in a split spring market. A split spring market is an environment where housing activity and buyer engagement vary drastically from one local community to the next. National housing averages are practically useless right now. A slight dip in nationwide inventory tells you nothing about the specific zip code where you want to buy. The first crucial local metric you must track is early buyer interest. Monitor changes in home views and physical showing activity in your target neighborhood. The second, and more important metric, is seller capitulation. You need to measure exactly how often local sellers drop their asking prices or delist their homes when they fail to get their initial price. Tracking local seller desperation provides a far more accurate timeline for when to buy than waiting for the Federal Reserve to announce a rate cut. To determine if you should execute a move now or hold your position, we can use a scenario match framework. This chart shows a decision tree starting with your primary moving motivation. The first input question is your desire to move driven by a mandatory life event, or is it an optional upgrade? If the move is an optional upgrade and your local market has low inventory with stubborn sellers, the combined cost of the mortgage and the asking price creates a significant financial hurdle. The trade-off is clear. You avoid locking in a high monthly payment, but you must accept your current living situation for another year while actively building a larger down payment. If you have high job security, a necessary life move, and you are tracking local sellers dropping their asking prices, you fit the tactical buyer profile. Your action plan is to re-engage in the market immediately. Utilize proactive rate lock strategies with your advisor to capture brief dips during volatile weeks. The trade-off for the tactical buyer is that you accept historically higher borrowing costs today to secure your housing need. You plan to refinance only if the macro environment shifts years down the line. Stop looking at conflicts in the Middle East to decide if you should move. Base your spring housing decisions entirely on your personal budget stability and the for sale signs right outside your window.